warahmatullahi wabarakatuh. Selamat sore, salam sejahtera untuk kita semua. Jumpa lagi dalam sesi webinar EXPO Profesi Keuangan 2020 yang pada sore ini memasuki sesi yang ketiga. Bersama saya Ari Yuliarti yang akan menjadi MC Anda selama 2 jam ke depan. Webinar ini ditayangkan secara langsung pada website profesikeuanganexpo.id dan juga channel YouTube Pusat Pembinaan Profesi Keuangan. Seluruh peserta berkesempatan untuk mendapatkan e-sertifikat dengan memasukkan kata kunci yang nanti akan ditayangkan oleh moderator di tengah-tengah acara. Webinar ini akan sedikit berbeda dan tentunya menarik karena kami telah mengundang pembicara dari internasional sehingga seluruh materi nantinya akan dibawakan dalam bahasa Inggris. Jangan lupa untuk menyampaikan pertanyaan melalui menu Question and Answer pada website atau melalui link Slido sebagaimana kami tampilkan di layar Anda saat ini. Pertanyaan dapat Anda ajukan dalam bahasa Indonesia maupun dalam bahasa Inggris. Dan jangan lupa cantumkan nama dan instansi asal Anda. Sebelumnya saya ingin menyapa dahulu para pembicara kita hari ini. Good evening ladies and gentlemen. How are you today?
Fine, thank you.
Very good, thank you.
This is the third webinar session of the Financial Professional Expo 2020. My name is Ari Yuliarti, who will be your master of ceremony of this session. Before we start, I will show you the welcome video from the President of Indonesian Institute of Certified Public Accountant, Mr. Tarko Sunario.
Ladies and gentlemen, good afternoon. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera untuk kita semuanya. Firstly, I would like to express our gratitude to the Almighty God. Today we can meet via virtual to join in the seminar with the topic of integrated reporting and key audit matters. Further, on behalf of IAPI, we thanks to the head of Center for Financial Profession Development, Pak Firman, and all of his staff who have given us the opportunity to have a seminar event as part of the Financial Profession Expo 2020. IAPI also thanks to our speakers, Mr. Paul Chan, Mr. Statis Gould, Mr. Jonathan Labri, Mrs. Kusumaningsi Angkawijaya, and our moderator, Mr. Hendang Tanusaya, who has spending your time to join us in the webinar. We also thanks to the organizing committee, which is executive management of IAPI, for supporting and preparing this webinar. IAPI also thanks to all participants on spending your time in joining this event. Ladies and gentlemen, as we know that the financial statements are currently the main instrument of reporting from a business entity to communicate performance information to users for decision making. However, at this time, many opinions exist that information in the financial statement are not enough to meet the user's need for such decision. Therefore, it is required another type of reporting that covering non-financial information to complete the financial statement. Currently, there are many models of reporting out of financial information, such as annual report that cover topics of, for example, Director's report, management description, management analysis and discussion, or description of operational and financial performance, or other model like sustainability reporting, corporate social responsibility reporting, and so on, that are still being considered cannot yet respond the need of users of information in decision making. Integrated reporting that developed by International Integrated Reporting Council has been believed as a reporting model which is able to complete all information needs by users for both financial and non-financial. IRC explained that integrated reporting as a process founded on integrated thinking result in a periodic integrated report by an organization about value creation over time and related communication regarding aspect of value creation. IRC also explained that integrated report is a concise communication about how an organization's strategy, governance, performance, and prospect in the context of its external environment lead to the creation of value in the short, medium, and long-term period. IFAC, as the global professional accountants organization, has encouraged all members to widespread adoption and implementation of integrated reporting in their respective jurisdiction. Integrated reporting can be used as an umbrella report for organization broad suite of reports and communication, enabling greater interconnectedness between different reports. Integrated reports is the way to achieve a more coherent corporate reporting system, fulfilling a need for a single report that provides a fuller picture of organization ability to create value. Public accountant in Indonesia, as auditors, can take the opportunity to play a role to provide assurance services on information other than financial statement that presented in integrated reporting using existing standards. Otherwise, public accountant also do the role to provide consultation services on integrated reporting, such implementation and socialization. This webinar is held to support and promote better understanding on integrated reporting for accounting profession in Indonesia. This webinar is conducted by IAPI in cooperation with IFAC, supported by ISP and RC, as well as the Ministry of Finance, as IAPI's active contribution in supporting the sustainability economic development in Indonesia. This event is a great momentum for us, public accountant in Indonesia, in understanding and implementation of integrated reporting. IAPI is committed to full support of IFAC, ISP, and RC programs in the following development of integrated reporting and other programs. Finally, we congratulate to all participants in joining this event, and hopefully this event will be fruitful for us. Thank you. Keep healthy.
For sending us the video, Mr. Tarko Sunario. Ladies and gentlemen, this webinar will be talking about integrated reporting and key audit matters that will be delivered by our expert speakers from the International Integrated Reporting Council, the International Federation of Accountants, and from the Indonesian Institute of Certified Public Accountant. If you have any question, you can submit the question using question and answer menu on the website or using Slido as appeared in your screen today. All of these speakers will be guided by our moderator, Dr. Hendang Tanus Jaya, CPA, CPMA, FCPA. He is one of the chairmen of the Indonesian Institute of Certified Public Accountant, and currently as the managing partner of public accountant firm, Darmawan Hendang Kaslim and Partner. Please welcome Dr. Hendang Tanus Jaya.
Thank you, Ari. Good morning, good afternoon, and also good evening for the speakers and all of the participants, and also distinguished representative from IFAC, from Finance Professional Supervisory Center, and from all of the participants. First of all, I would like thank you for joining the webinar, and hoping that this event will be run smoothly and fruitfully. First of all, we are very glad today. We have 4 prominent speakers. Yeah, 3 of them is coming from abroad. Mr. Paul Chan, Mr. Jonathan, Mr. Tastis Gold, and the last, Ibu Kusumaningsi. So before we start, let me introduce the brief curriculum vitae one by one. First of all, I will introduce you with Mr. Tastis Gold, the Director of Advocacy IFAC. Mr. Statis Gold head up the development of international service for professional accountant working in business and industry at IFAC. A key element of his work is developing thought leadership and guidance in support of finance professionals and their role facilitating sustainability organizational performance. Before moving to IFAC, he was at the Chartered Institute of Management Accountant, or CIMA, responsible for planning and overseeing a program of policy and research. Prior to serving the accountancy profession, Mr. Gold worked in various roles in the private and public sectors in the UK. And then the second person for our distinguished speaker is Mr. Paul Wei Chan, FCCA, FCG, FCPA. Paul is the President Malaysian Alliance of Corporate Directors, Executive Members of Global Network of Directors Institutes, Vice President Federation of Public Listed Company, IIRC Ambassador and Chairman ASEAN Integrated Reporting Committee, President of Business Transition Asia, and also adjunct professors of Sunway University. Paul is the board chairman of a Malaysian listed ICT service company. He has served over a dozen boards of public listed and privately owned companies in various industries. A chartered accountant, fellow members of SCA, Chartered Governance Institute of UK and CP Australia. He's an NACD Governance and Board Leadership Fellow of National Association of Corporate Directors, USA. He's based in Malaysia now. Next. So our third speaker is Mr. Jonathan Labre, the Chief Strategy Officer of IIRC. Jonathan Labre leads the International Integrated Reporting Council's global strategy and policy development, which aim to create the condition for integrated reporting to flourish. Jonathan has a background in government relations, policy and regulation, having head up the public affairs and policy team at the RCAEW from 2004 until 10, and at the RIBA from 2000 until 2004. From 2010 until 2012, Jonathan has head of communication at the UK Financial Reporting Council, the Accounting, Audit and Corporate Governance Regulator. He started his career as a political advisor in the UK Parliament, having read law at King's College, University of London. Now, our last speaker is Mrs. Kusumaningsi Angka Wijaya. Mr. Ningsi is also a graduate from abroad. Yeah? Like you can see in the screen, Bachelor of Science in Accounting from USC, Master of Business Administration from Southern Illinois University at Carbondale, USA, and also taking an accounting profession from Indonesia, Faculty of Economics. A holder of CPA from IAPI, and also a CA, Chartered Accountant from IAI. Professional experience, he's up till now the partners in public accounting, Siddhartha Wijaya and Rekan, a member firm of KPMG International. She's also served as Board of Indonesian Auditing and Assurance Standard Board 1 from Institute of a Public Accountant in Indonesia, atau IAPI. That's all about the curriculum vitae of the four speakers that will deliver the speech. In order to brief the time, let us begin with the speaker number one, Mr. Paul Chan, that will deliver the topic integrated reporting overview and trend in the ASEAN region. Now, Mr. Paul, the time is yours. Thank you.
Can you see my slides?
Not yet, still not yet.
Okay, it's on my screen already.
Okay.
Anyway, thank you very much, Pak Hendang, and thank you very much for AIP, for IFAC, and also IRC for inviting me to share my thoughts with you on the issue of integral reporting. I call this a paradigm shift in corporate reporting. Is my slide up already, by the way? Is the slide up?
Not yet.
Still not yet, no?
Not yet. You have to.
Oh, okay. I'll just wait for a little while. It's on my screen.
Yes. Share screen and then.
Yeah, share screen. Yeah. Is it you're on share screen? It's already up.
Yes.
Paul, we see the file, the file, but we don't see the actual slides.
I think it's coming up slow, but here it says you are screen sharing now. Did you see it? I think there is a little red.
You have to share another screen or something.
No, wait a minute. I think it's coming up slowly. You are using enhanced inscription. Let me see here. According to, oops.
Working now.
Oh, very good. Excellent. Thank you very much. So thank you very much again, Pak Hindan.
Yes.
And for IAP, for IFAC, and for IRC for inviting me to share some thoughts with you. Okay, I titled it as a paradigm shift in corporate reporting because a lot of things have changed in our environment today, that our corporate reporting today appears to be critical and essential, and yet is quite inadequate. Right, that is why we move into the area of broader scope of reporting. So as I call it, a paradigm shift in corporate reporting. Right. Let me see. I cannot move my screen. Hold on. Okay. As we all know, that all of us are today is interrupted by this coronavirus issue. All right, the disruption caused a lot of losses to a lot of companies. And even ourselves, Malaysia today has been, we have been warned that by the midnight today, we will go for the next, they call it MCO, all right? That is, we're going to be locked down again, all right? So because of all these things, I think the slide is moving a bit slower. Okay, and because of all this things, you can see that a lot of companies today are struggling. Many of them are closing down. As you study today in the US, for example, Hearst is no longer there. You find that, you know, even Warren Buffett lost a lot of money, and BlackRock, again, you know, is finding difficult to manage those huge funds that they have. The biggest mall in US also closed down. In Malaysia, many companies are also suffering, especially the tourism industry. That has been disrupted by, unfortunately, this coronavirus, right? So we are living in a very, very volatile world. I call it the VUCA world, which I'm sure you're familiar with it. We're living in a world today that is highly volatile and highly uncertain, very complex, as well as very ambiguous. We don't have the luxury of you know, have all the information on our table before we make decision. We really have to make decision on our feet, right? So as you look at the study made 75 years ago in companies, or rather 50 years ago, companies' life cycle in S&P companies in the US is 75 years. Today, it has gone on to 15 years. In other words, the company can survive only for 15 years today. In fact, there's a projection for 2027. It goes down further to 12 years, meaning that the turnover of companies they're cropping up and dying is very, very high. All right, what has it cost the company to be such a challenge, such a big challenge here? Even before the coronavirus things came in place, right, we find that the company has been disrupted by a lot of things which are technology related, all right? That means to say that actually the technology has displaced many, many industry, many professions, as well as many companies that couldn't survive. I think the slide is not moving too fast. Yeah. As you look at the digital disruption, the impact on almost every industry, right? Whether you talk about e-hailing industry, the hospitality industry, the retail industry, the almost every industry. The one thing in common in all this disruption, you notice that most of these companies don't own very much assets. They are really valuable because of the technology behind those companies. And today they are leading the world in terms of the value of the company. Right? This is the latest study from Ocean Tomo. You see, when they did the study, it said in 1975, the value of a company made up of 83% of tangible assets, right? But today it is reversed. The latest statistic that they have in July this year is that the top 500 S&P 500 companies in Malaysia, in the US, right? 90% of those value of those companies are intangibles. Only 10% are tangibles. Now, this actually poses a lot of challenge to the financial reporting that we received, you know. It's a similar thing in the component of S&P Europe 350 market value. More than 2/3 of those values of those companies in Europe, in S&P Europe, are intangibles. Only 26% as of 2020, 26% of tangible assets. Right. Now, what does all this mean to us? I sometimes go back and forth from wearing my hat as a corporate director, as well as a CPA, an accountant, right? So what we are looking forward to, the accounting profession to help us, is to really understand and how to put our arms around those value of the company that that we have the most in terms of the value, but least in terms of the reporting, right? I also make as an analysis of the Jakarta Stock Exchange top 100 companies, the top 100 market cap company. When you drill down further to the sector itself, you look at the intangibles assets against the market value of the companies in Jakarta Stock Exchange, right? In communication industry, 56% of those companies are reported in your financial report, all right? That's a tangible assets. 44% of which is the market value of the company, the market perception of the value of the company, what I call the intangibles, right? That is communication, 44% are intangible, not reported in your financials. Consumer non-durables, 57%. Health technology especially, 81%. Consumer durables, 34%. What this indicates to us is that the financial report we accountants read, or we accountants and auditors prepare, are only on those within our standard, which is the tangible assets, where there's a transaction, right? Now, if you look at what this Grab car, I'm sure you're familiar with that. This is a Malaysian homegrown company, but eventually it went to Singapore. Head office is now in Singapore. The company, the last time I looked at it, they have a share capital of 370 million Sing dollars, but they have a cumulative loss of 350 million, right? And yet the company's value is 14 billion, right? Why are these companies like SoftBank, Toyota, didukung, Microsoft investing in companies like that when the company's financial is so weak, right? Now, it's the same thing when we look at it as financial advisor or financial professionals. We normally look at companies from the balance sheet and determine what is the value of those companies, right? Now, in the case of Grab, you have got Gojek in Indonesia, right? Today's valuation is 14 billion for Grab, and Gojek is 10 billion. And I can tell you, Grab today is not even, hasn't gone through the IPO yet, right? So if you purely look into the financials without looking into the marketplace and all the intangibles you're talking about, you know, there will be some form of a misalignment of the value of the company as against the book value of the company, right? We are doing Zoom now, right? Same thing, Zoom today is bigger than the 7 largest airlines that put together. Now that was a figure that I have in January 31st. In today's environment, I can tell you, Zoom is bigger than probably more than a dozen airlines. Airlines are really in big trouble today. Now, what is the difference here? Now, Zoom has an equity of 834 million, book value of 299, but the market value per share is 175 at January, with a market cap of 48 billion and a value multiple of 58.5 billion. What's the difference now from the book value and as against the market perception of the value of those companies? Now, with all this technology going on very, very rapidly, in the World Economic Forum, when they came up with this study in 2018, all right, what they predicted was in the next 2 years, all right, 2022, the top emerging profession that are coming up into the marketplace, 7 out of the top 10 are IT related. So you have data analysts and scientists, you have AI and machine learning specialists, software application developers, you have big data specialists, digital transformation specialists, new technology specialists, information technology. So you see, all this is very much aligned to the market changes that
With me, Paul.
Yes, sorry.
About 3 minutes more.
Is it? Because I put my time here. Okay, now my.
Okay.
And I put my time here. I have 9 minutes according to my time. Anyway, okay, it's fine. I try to rush it up.
For each person.
Okay.
Yes.
And the declining profession are among those accounting and accountants and auditors. Right. That is what they said study. Now, there's a very interesting book that came out in 2016 called The End of Accounting. Now, what this author was talking about, I met with this author in New York last year. What they're talking about is that we devoted so much of the effort in giving the accounting report, and yet only 3.4% of the time that investors look into the accounting quick forward decision. What they're talking about is that this information that we verify, we assure supposedly, right, to address the investors. And yet the investor look at so many other different places to get the information, whereas less than 5% of the time going for accounting information, right? So this is what happened in the accounting profession. The International Accounting Standard 38, they call it, the condition to capitalizing all these intangibles, right, has got this probable future economic value with the intention to complete, resources must be adequate to finish the project, ability to use it or sell it, technical feasibility, and expansion reliably measured, right? And somebody put it very nicely, the acronym for pirate here. So we are, in a way, because of the constraint, the standard that we have adhered to, we cannot take all this investment into human capital, R&D into the balance sheet, right? So we are boxed into this standard. Now, there's a report that came out from E.ON. E.ON is a huge risk management company. And this gentleman, the CEO, was talking about that they are falling far behind of the market perception of the company value. The 75% of the market capitalization is driven by intangibles. And he has analyzed 8 different types of intangibles that made up 20 to 25 trillion US dollars in the US market. So the big question to me is that I think he's crying for assistance from the professional to put an arms around it. How do we put a value, all right, a methodology for these intangibles? Okay. I wrote this article, Governance 4.0. This is last year. I was talking about from a director perspective, from a board perspective. When we see that financial reporting to us only covers such a small percentage of the tangible assets, we have to consider whether we have fully discharged our fiduciary responsibility by not disclosing other aspects of the value that is not in the balance sheet. Okay, so that is this article is about redefining and reinventing governance. That means we redefine what is capital, we redefine what is asset, and things like that. If you wish to have that article, I can send it to you. Last year also, I attended this United Nations International Standards of Accounting and Reporting, which Jonathan was there as well. They are moving into a direction of implementing this 17 SDG by the year 2030, which is 10 years down the road. Will accountants be part of this exercise? I certainly feel that we should, because the accountants are involved with capturing all this data, all right, to demonstrate how are we complying with the 17 SDG. Right? Okay. Now this is where the IIRC has come up with this framework where they're mapping the 17 United Nations 17 SDG, the Social Development Goals, into the IRC framework of analyzing the various capital. There are 6 capital analyzed here, and how do we deploy all these capital resources? How do we allocate the capital in order to create value that eventually come out as a output and outcome, aligning to achieving the 17 SDG goals of the United Nations, right? This is just an example in Malaysia. Malaysia Airport has already gone into integrated reporting. You can actually Google Malaysia Airport. You can find more detail on here. Just an example for you. And of late, there is also another organization called the Bintulu Port, right? It's also aligning the business reporting to integrated reporting. Right, this is their reporting framework for Bintulu ports. It's interesting that in the early 70s, I read this book called Paradigms, the business of discovering future. What it says is that the paradigm shift. When there's a paradigm shift, everything goes back to zero. The biggest question to accountants, which the board of directors rely on for assurance of the financial information, whether the shift of the corporate reporting is a threat to the profession or an opportunity to the profession. I look at it this way: there's a lot of opportunity for accountants to reinvent themselves, to upgrade themselves with the very core skill they already have, right? And take advantage of it. Move into integrated reporting, understand the whole concept of it, and also align it together with the United Nations 17 SDGs. There's tremendous opportunity over there for us to reinvent ourselves. For board members, we are interested in the guidance of strategic input from the accountants, not just the financial figures, right? And this is what the Professor Mervyn King has come up with. All right, he came out with a book called A Chief Value Officer. Financial accountants or financial controller of accountants today are no longer just accountants for financial, but a much broader aspect of looking after the sustainable development of the planet. And he came out also with the other book, 2018, they came out with this book called Auditor Kovadis, telling the auditors, where are you going? So I would encourage you to have a good background of integrated reporting. Is get hold of this book. It's a very small book, very simple to read, and you have a better understanding of the background, right? So if there's a further question to this, I'll be much happy to take the question afterwards, or you can send an email to me, and we go on from there. That's all I have to present to you. Thank you very much for your time.
Thank you, Mr. Paul.
Yeah. Thank you.
As you know that we have four panelists. The question and answer session will be run at the end of all of the panelists. Then please just a gently reminder that please raise your question using the Slido or Q&A from the web. And also before the end of all of the session, speaker, please fill out the form in the link provided at the bottom. Then also there will be a keywords that will be informed later during the session in order to get the e-certificate. So the panelist number 2 is Mr. Statis Gold from IFAC, New York. Good morning, Mr. Statis. I think that.
Good morning to you, sir. Hello, Hendong.
Yes.
Hello, everybody.
Yeah.
Can you see my slides?
Yeah. This is your slide. You will talk about the topic of accountants and integrated reporting, yeah, about the understanding and communicating value creation from a business and investor perspective. Now, I think that the time is yours for 20 minutes, yeah, Mr. Statis? Okay.
Thank you, and thank you to Paul for setting the scene. And welcome, everybody. It's lovely to be speaking with the Indonesian Institute of Public Accountants. Of course, you're associate members of IFAC and your journey hopefully will see you as full members and join the IFAC family of 175 professional accountancy organizations around the world, and the benefits that come with it. So it's very we really look forward to having you as full members of IFAC in the coming future. Just to follow up on what Paul was saying in terms of thinking about the future, these are unprecedented times. They're very challenging times, and of course what's happening around us means there's a very significant change in the context that we're working in. So obviously we have extreme uncertainty, a recessionary environment in many places, and new and emerging risks, whether it's in relation to people, talent, climate, supply chains. So within this environment, what we're seeing, of course, is businesses changing how they deliver value through changes in the business model, rapid shifts to digital-based business models, virtual and agile operating models, and much more remote working, of course, with new working practices. And of course, this all impacts us as finance and accounting professionals. It impacts us in terms of our priorities and what we do to support our employers and our clients. And it really does mean that we're becoming more forward-looking. We need to help the people that we'll work with to deal with uncertainty, providing the relevant information and insights that help sort of us chart a path into the future within this very difficult business environment that we find ourselves in. And when I think about what a future fit accountant is today and tomorrow, much depends, of course, where we're working as an accountant, and we may be in our practice, we may be in an organization, in a finance and accounting team, or we may actually be within the business itself. But regardless of where we all have to be focused on delivering the insights and the information that boards, management, our operational colleagues need to steer their businesses towards enterprise value creation and understanding their corporate impacts, and enhancing confidence and the credibility in the information and the data that they're using. So really, for me, it's about ensuring organizations understand and consider all of the factors that impact its ability to continue to operate and create value into the future. And I'm glad Paul mentioned Mervyn King's book and this whole idea of a chief value officer. And I think this is really an enormous opportunity for the accountancy profession. And it really is a shift in mindset than a shift in job title. It really represents this evolution from thinking about everything through financial performance and financial capital, thinking about things in terms of value creation. And we'll talk about that in a moment. So I think this being a chief value officer really positions us as in enabling the integrated thinking and reporting agenda. And that's really all about managing priorities for resource allocation, performance and accountability across all of the value drivers and the capitals in a business. And that means, of course, being comfortable with financial information and alternative performance or non-GAAP measures of performance, and also the non-financial information, which covers intangibles, environmental, social and governance factors, and issues around sustainable development and the SDGs, as Paul quite rightly highlighted. So that's a very big universe of information. Just thinking about integrated reporting for a moment, and I know Jonathan after me will talk much more in depth about integrated reporting, but just to set the scene in terms of what I'm going to tell you, I think some things that are really important to note are that integrated reporting is really value creation reporting, and it's very much a process as well as a product that leads to an integrated report. But a lot of the benefit of organizations is in in the process, and that process is related to integrated thinking. And integrated thinking is very much about the connectivity, or connecting information, connecting people, connecting processes, and those factors that are really relevant and material to a company's ability to create value in the future. And it's based on this notion of multi-capitals. And multi-capitals is very much about the variety of different sources of value creation that we depend on, and we'll look at those in a minute. But those multi-capitals then need to be used in our planning, in our performance management, and in our data sets and KPIs that we deliver. And of course, integrated reporting is very much based on a wider stakeholder perspective. So to really understand value creation, one has to really be in touch and in tune with what are the expectations and needs of key stakeholders. And that wider stakeholder insight gives us the understanding of risks and opportunities related to value creation. And actually, that then provides the basis for us to communicate more effectively with investors and providers of financial capital. And that will end up in an integrated report, which is an umbrella report which needs to be concise, strategic, and forward-looking, and combining all of these relevant aspects of financial management, sustainability reporting into a coherent whole. And I think I would just say that for many companies, the starting point can be different. Sometimes they start with the reporting, sometimes they start with the thinking and the management process. So, you can sort of step on this journey depending on what works best for your organization and your maturity, current maturity in reporting. So just thinking about value creation more broadly, I think the important thing to understand with accounting for value creation is that it is capturing what is important beyond financial and shareholder value. And that really in itself presents very important questions about how, as accountants, can we contribute to value creation. And to contribute to this wider agenda, I think we need to be very mindful that we're not caught in this paradigm of measuring everything through the IFRS and the financial statements, and where the returns to shareholders is the primary, or people think that returns to shareholders is the primary measure of performance and success. There's a real shift here in integrated reporting of really thinking about our purpose and how we present success and value creation much more broadly. And I think this is really important, and where we can educate companies about this, I think we have an enormous opportunity. So really rethinking value creation for us is really driving the agenda of CFOs, of finance teams, of us as advisory people and auditors. And it's about providing those insights on how value is created today and in the future, using the multi-capitals as a basis. It's beyond reporting as well. It's really about trying to ensure that we help develop resilient organizations that have value creating business models. So the reporting needs to lead to an end game. And let's not forget that. So it's not reporting for reporting's sake. And within this, we have to then comprehensively track performance and value through various dimensions, which I'll turn to in a moment. And then we have to provide confidence in that information through assurance. And I think for us as a profession, this is our broader mandate in value creation and protection. So you can go to the IFAC website. We have a Rethinking Value Creation webpage where a couple of recent reports that we produced on this and our thinking on this are available. And this is really the basis of what I'm going to talk about now. So in terms of just bringing in integrated reporting alive, we really have to, as accountants, then begin to think, well, what is this value creation universe that we're all talking about? And we talk about it from three perspectives. Of course, there's the perspective that we're very much familiar with, which is the financial perspective, and that it comprises traditional accounting, capturing transactions, the profit and loss statement, the balance sheet, of course, and that all is a measurement of book value. But of course, as Paul quite rightly said, there's a huge area of enterprise or business value that is very much about the potential for value creation that's driven by strategic and intangible assets. And in terms of enterprise value creation and market capitalization, of course, the measure of market value as compared to book value really gives you that number. And this is very much forward looking. And then, of course, on top of that, there's something else which is really important, I think, for us to understand. There's actually a societal value, and what is society's perspective of us as an organization and the impacts we're having on the external environment, on our society, and on our stakeholders. And a lot of those factors are not actually reflected in current financial numbers and cash flows. So this, I think, is for us, where we need to think about, well, where are the integrated reporting capitals relevant to these three perspectives of value, and then what are the key value drivers that we're going to capture in order to track and better understand these sources of value. So in relation to the to the performance of a company, we'll be looking at conventional performance and value drivers related to, financials, operations, and customers. So, and that will include all the alternative performance measures and non-GAAP information. Then there's information about relevant intangibles that just drive strategic value, and a lot of the main ones that are relevant to many companies are people, intellectual property and capital, data, R&D and innovation. And then we have these factors called environmental, social and governance factors that are increasingly important and used by investors and others to look at and understand the opportunities and risks to value creation. So we really need to come up with a mixture of measures, indicators and information relating to these three perspectives. And I'll just, before moving on, reflect on a few things here. And when we're talking and thinking about measurement metrics and KPIs to capture the relevant business value drivers, I think it's important to think that value drivers, financial value drivers, need to be linked or connected to performance in other non-financial areas. So connectivity between the financial and non-financials is really important, and I think that is something the accountants should be really helping organizations to think about, is connecting the financials to the non-financials and understanding financial impact. For many non-financial risk areas, and climate change and climate risk is a really good example of this, there are both accounting implications where the risk may have already crystallized, and then that risk needs to be, and that impact needs to be reflected in the profits and valuation of the company at the moment. And that then brings us to translating that into the IFRS world. So for example, if you have to impair assets, or a climate risk has had an impact on the organization already. For example, you may have a fleet of diesel trucks that if you only have a 3-year life cycle because you have to change your fleet of trucks to electric, then that value, the value of those trucks would have to be written off. So there are immediate accounting implications to a lot of the risks that we're facing, and they can be picked up and captured in IFRS. But also there's the tangible and intangible assets that are important in terms of this forward-looking sort of long-term cash flows and earnings, and they're very much picked up in the integrated report and the management report, and that includes, of course, the ESG information, and the environmental, social, governance information provides us more understanding about those opportunities and risks, and where there may be increases or decreases in the expected value of a company's tangible and intangible assets. So, for example, responsible products greener products can drive revenue. Efficient and low carbon production and processes can reduce operating costs. Investments in people, talent and diversity can improve productivity and innovation. And socially acceptable practices in the supply chain and within our communities that we operate within can ensure a license to operate. So I think all of these factors together enhance our brand value and our reputation and our license to operate. So one of the things I think we'll be doing as accountants is really thinking about, well, what are the relevant capitals, value drivers in our business, and what are the lead and lag KPIs and measures we need to connect and track in order to give us a picture of performance and value creation in our organization. So one of the reports that I'm not going to dwell on now that we produced does look a little bit more deeply at understanding value creation, because value creation, of course, is on one level quite a nebulous thing, and value can only really be understood and defined, as I said before, by really understanding your customers, your investors and your other stakeholders and what their legitimate needs and expectations are. So that stakeholder engagement in being outward looking as accountants is really, really important to understanding the sources of value creation. And then understanding how value is then created through the organization and what its purpose and mission is. You know, that needs to be broader than just delivering value to shareholders and investors. What is our strategy and our business model? And then how value is delivered to customers, governments and society through our products and services. And as accountants, how we're delivering that value, at what cost and at what price can we deliver that value to ensure that we're a resilient and a business and a going concern going forward. These are all in the domain of the accounting profession. And then showing how value is then sustained and shared. How much value in terms of, you know, ongoing uses of cash, for example, do we keep within the organization for reinvestment? And then what value are we distributing to others outside of the organization in terms of dividends, tax, remuneration and wages, and being transparent about that. I think it's worth connecting what we're talking about also to this data-driven world that we're in. And of course, one of the biggest things that is affecting us and what we do in the accounting profession is technology and data. But data and integrated thinking and reporting are very much connected. And I think a lot of the understanding and judgments we make, either as accountants or within the business making decisions, has to be based on relevant and quality data and analysis. And data actually is helping us, and the tools around data are helping us to better track how an organization creates and protects value. And in terms of you know, the tools and statistical models and analysis relating to non-financial capitals and those non-financial areas, and enabling us to be more forward-looking in terms of scenarios, sensitivity analysis, data that helps show us relationships, correlations and causation between different drivers of value. That is going to be really important. That's important to move us away from spreadsheets. It's important to help us have much more power and insight in the information and analysis that we're providing to business. So that data-driven technology and tools is a really important part of the integrated reporting conversation. And I think accountants really need to think about how they lead on data ownership, accountability and analysis related to all of the non-financial capital areas. So just to summarize in a couple of slides, I think accountants, of course, enhance decisions and they enhance reporting. And depending on what you do in your organization or with your clients, I think there's various stepping on points on this train. There's a data collection processes and systems part of this, making sure non-financial information is as important is this as trustworthy as the non-financial information, ensuring that we have the relevant data and insights we need in terms of our performance reporting, our risk management, our business and financial planning, our capital investment, our financing, and our external reporting and communication. And ultimately, integrated reporting and robust management information will lead to better reporting. And then just to reflect on assurance before I hand over. Assurance, I think, of course, is extremely important for the accountancy profession, and providing confidence in integrated reports and the non-financial information through reasonable assurance or limited assurance. And this, of course, involves rigorous evaluation of processes, systems, and data. So there is a global standard, which is ISA E3000, which links to our code of ethics, our independence requirements, and quality control, ISQC1. And I think we really need to think about how we use our specialist knowledge and competence in assurance to deliver assurance of non-financial information. That assurance, the demand for assurance is going up, and assurance can be provided by other professional types or other types of firm. So we really need to think about, well, how do we plug that demand and fulfill that demand that many companies now have for bringing in assurance providers to help them not only provide confidence in the information that's being reported, but to help them improve the systems and data and processes in their organizations. And research shows that companies who obtain sustainability assurance from an accounting firm actually gain a much bigger advantage in terms of their cost of capital and the coverage that they get and the trust that they get from the capital markets. So I think it's really important that we bring our expertise in evaluating internal systems, processes for collecting, analysing and reporting information, which we then can supplement with other expertise that we may need to deal with the specific subject matters that we will be addressing in an insurance engagement around non-financial information. So with that, I will hand over to Jonathan to talk a little bit more about integrated reporting, the movement, and some of the key components of integrated reporting.
One minute more, Mr. Tatis.
Oh, thank you. I'm handing over to Jonathan now.
Yes, okay.
Thank you. Thank you very much indeed. Well, thank you, Stathis, and also to Paul for your really valuable insights. I'd also like to thank IAPI, IFAC, and the Ministry of Finance and CPA Indonesia and other organisers for this incredible webinar, which I understand is being broadcast to around 500 people in Indonesia today. So it's wonderful to be able to reach so many people across the profession and the business and accountancy community. I was last in Jakarta in November last year to speak at the Asia Pacific Investors Cooperation ASEAN Pension Funds Summit, and I had the privilege of meeting there the CFO of BPJS, Indonesia's social security organization. And BPJS have adopted integrated reporting and integrated thinking. And it was wonderful to hear the benefits of breaking down silos, of adopting that multi-capital mindset, which Stathis was just talking about for the organization. And there was great enthusiastic buy-in from all the team within the finance division of BPJS, because they were recognizing the strategic value of finance and how it really does contribute to broader value creation in the round. So I think really to speak to Stathis's point, this is something that is finance profession led. It is reimagining the finance profession in the modern world and connecting finance to the other strategic drivers of an organization, working with the CEO and others to really understand the business model and drive the strategy and business performance of organizations. So it really is a great opportunity to once again engage with the Indonesian business and accountancy communities. And what I learned when I was in Jakarta last year is that there's really great interest within the business and accounting communities to upgrade professional practices to take advantage of opportunities that come from modern corporate governance, but also sustainable development and innovation, because what we're talking about here is innovation. Innovation in reporting, innovation in governance, but also drawing on innovation that is in all of our businesses and finding ways of explaining how that innovation contributes to broader value creation in the 21st century. Now, it's easier to understand the problem and easier to understand the context than it is sometimes to find the practical solutions that are going to help your businesses or help your accounting organizations to make sense of a very vastly changed external environment. And we always say that integrated reporting is a response to the megatrends that are occurring in the world today. And those megatrends are best explained by the World Economic Forum in their annual Global Risks Report. And what they say is that the risks that the world is facing today are both multiple and interconnected, and they're simultaneous. So they're coming at us from all directions at the same time. And therefore, we need different ways of thinking about how we create value, how we think about performance in that kind of context. Now, we know about climate risk, and we know that climate risk has a financial implication over the short, medium, and long term. So one of the things, as Stathis was saying, that integrated reporting seeks to do is change the horizon over which we disclose information. So at the moment, we think about corporate reporting through the rear view mirror. We're looking backwards at performance. What integrated reporting seeks to do is project into the future and look at performance from the perspective of today's megatrends and how they're going to affect your company over the short, medium, and long term and into the future. Because we know, if we think of just that narrow area of climate risk, that it will have a material financial impact over the medium and the long term. Stakeholders, investors, employees, customers, suppliers need to understand how your businesses are taking account of those climate risks today in your business models and allocating resources so that you can build a sustainable business for the long term. And that in turn builds trust and confidence in your business for the future. We also know that we are living through what the World Economic Forum calls the beginning of the fourth industrial revolution, where robotics and automation are going to drive different business models and business model disruption in the future. So again, by taking account of these trends within today's thinking, within today's governance, then you can prepare your businesses for the long term and ensure that your businesses have resilience and the ability to deal with those challenges over the longer term. And we believe integrated reporting is really a corporate governance tool. It's a tool for management, it's a tool for the accountancy profession, it's a tool for finance teams to really take control of the business model and the strategy of the organization, and to embed what Stathis and Paul talked about, that integrated thinking, the breaking down of silos within your organizations so that you can truly understand the interplay between those different drivers of value or the capitals we've spoken about. Now, the IIRC, the organization that I represent, is the International Integrated Reporting Council. And we're a coalition of organizations that are mainly international organizations that have come together in the world. And this is really a visualization of our council meeting. We've got on our council the world's largest asset manager, BlackRock, as well as other leading investors. We've got the standard setter for international financial reporting standards, the IFRS Foundation. We've got the Japanese stock exchange, JPX. We've got leading business organizations, including Tata, DBS Bank from Singapore, and Nestle. We've got governments, including the Ministry of Finance in China. And we've got the accountancy profession represented by IFAC, accounting firms, and accounting institutes. That really does represent all of those global organizations with an interest in improving the quality of financial and other corporate reporting information in the world. And they came together 10 years ago to say, let's create a framework for integrated reporting that will shift the conversation within companies and within capital markets away from just looking at performance through a financial only lens and looking at performance through the broader lens, the lens that we know now impact value creation, the intellectual capital, the human capital, really drive value within organizations and how that connects to the other drivers of value within companies today. And so our vision really is to use that cycle of integrated thinking and integrated reporting to drive both better behavior and lead that to helping to deliver those wider goals of financial stability and sustainable development. So contributing to the sustainable development goals, which both Sathis and Paul were talking about. Now, the IIRC, as you will know, does not operate within a vacuum. We are not the only framework provider or standard setter for corporate reporting in the world. There are several other global organizations that are seeking to set standards and frameworks in corporate reporting. Now, what is happening this year is that we are all intensifying our dialogue and cooperation. So that includes the Global Reporting Initiative, GRI, SASB, the Sustainable Accounting Standards Board, CDP, CDSB, and ourselves, the IIRC. And we have come together to deliver a bold, once-in-a-generation statement of intent that we intend to work together and cooperate to deliver a single corporate reporting vision for what the system of corporate reporting standards and frameworks should look like for this century. We will be seeking government endorsement of that vision over the course of the next few months. And I would point you to the statement of intent that was issued on the 11th of September this year from those 5 standard organizations, because sometimes to the outside world, the world of standard setting and framework providing can look complex, and we're trying to remove that complexity and present the corporate reporting frameworks and standards as a single system. And why are we doing that? Because we know that what we're doing is actually not only in the interests of businesses and investors and capital markets, but it's also in the public interest. And according to just one survey, but there are many such surveys in the world, 96% of business leaders said that it's important to explain how their business creates value for their stakeholders in the long term. Why? Because it builds trust and confidence in those stakeholders. So they become longer term investors, they become longer term employees, and they become longer term customers as well. And as we move to a next generation of customers, the millennial generation, we know that that next generation has built within their DNA a commitment to society and a commitment to the environment. And they are willing to allocate their purchasing decisions, their economic power behind organizations that demonstrate their broader commitment to value creation in the round. And so you've seen a version of this framework, this business model diagram that is taken from the International Integrated Reporting Framework that we released in December 2013. And this really is a snapshot of what integrated reporting is all about. On the left-hand side, you can see those 6 capitals, those 6 sources of value that every company uses in the world in order to create value, and they are inputs into the business model. And that business model really explains how you're creating value, how you're creating your products and services, but then how you're creating not only the outputs from those products and services, the outcomes in terms of, for example, a healthier employment base, a healthier society. If you're a pharmaceuticals company providing drugs, then there are outcomes that are beyond the financial performance of your business. And then on the right-hand side, how are those capitals transformed over time and by the use of that business model? And critically important to integrated reporting is that external environment and taking account of your multiple stakeholders. So having that stakeholder analysis built in to your corporate reporting system and your corporate reporting practice. Now, I wanted to share with you a snapshot of a few examples of companies. Now, you're not meant to be able to read all of these in detail, but hopefully you'll be able to go away and have a look, because all of these examples are online. So these are examples of companies that are adopting integrated thinking and integrated reporting. The first example here is the bank, ABN AMRO. And what you can see here is really that business model diagram from our framework interpreted into a company setting. So what they're doing on the left-hand side there is explaining the different capitals, the different resources that they use as a bank to create value. And what they've sought to do is monetize where they can the value in financial terms, intellectual capital, the patents and copyrights, the human capital. How much are they spending on training, for example, to train their workforce, to build the value of their human capital? And then the impact on society and the natural environment. And in the middle there, you see the business model drawing on the different divisions within the bank to create value for its stakeholders. And then as we move to the right-hand side, you see the outputs, the outcomes, and critically, the impact on their different stakeholders.
Sorry, Jonathan, can you make it 5 minutes more? Thank you.
5 minutes, absolutely. Thank you. Munich Airport is another example. And again, you see here the example of the business model diagram from Munich Airport's integrated report. And what you see there is that the outcomes on the right-hand side are linked to each of the capitals on the left-hand side, and they're measured where possible. So the company is actually measured against each of the capitals, the value that has been created, and the outcome on its different stakeholders. That reflects the training in its people and the community engagement that the company, the Munich Airport, engages in day to day. And then there's the technology company SAP. We heard about the other principle of integrated reporting, which is the connectivity of information, the linkage between financial performance and the investment in the other capitals, the human and intellectual capital. And SAP has done a great job in its online integrated report in demonstrating the connectivity of information between the different capitals, the different resources and relationships that the organization uses. And then Japan Tobacco, another example of a company. And all of these companies are a snapshot of the companies that are in the integrated reporting at the IRC's business network. And you see here from Japan Tobacco, the value creation process, the business model, the investment in R&D, the three divisions of the company, and then how they're creating value, not just corporate value for the business and its shareholders, but also the social value, that commitment to investing in society and building social value. So you get a snapshot in each of these integrated reports of how the organizations are creating value and an insight into their business model. Now, there are a number of trends that we're seeing from the integrated reporting business network. We're seeing reports that are becoming more concise. We're seeing reports that are now committing to explaining how they're contributing to the SDGs, the Sustainable Development Goals. But of course, there remain challenges. How do you balance reliability and completeness? How do you forecast performance in a world when there are so many uncertainties? And how can you be specific about the future risks and opportunities? These are some of the challenges that the businesses are grappling with. Through the business network, we're helping companies overcome those hurdles in order to be able to explain value creation over the longer term. I think we've heard how integrated thinking really so important in terms of shaping the future of corporate reporting. And it's integrated thinking, which is really understanding the different drivers of value within the organization and breaking those silos down within the organization. So often it's the CFO taking charge and convening a group from across the company and saying, what is our business model as an organization? Because quite often companies are silo-based and there are different business models and different strategies that are being deployed across the organization. So in conclusion, we want to work with the Indonesian accountancy profession, the government and businesses and investors to bring integrated reporting to Indonesia and to bring Indonesian stakeholders into the IRC so that you can help to inform our strategy as well as advocates and as members of our own business network. So please do have a look at these resources that are on our website, and do get in touch with me through IAPI, and I will be pleased to send on my details to you, because the concepts that Paul, Stathis and I have been speaking about may seem new, but they're supported by evidence and by practice. And it's important to think of integrated thinking and reporting as a journey, and think of the IIRC as a resource for you on that journey. So I look forward to working with you and intensifying our conversation in the months ahead. Thank you.
Thank you, Mr. Jonathan, Mr. Stathis, and also Mr. Paul for your very helpful, faithful, very first speech. I think that it's all about integrated reporting, as is from the Mr. Paul Chan, from the trend in the Asian region, including the example of Grab and Ion.
Pak Denny?
Yes.
Yeah.
Ningsi, I think we lost Pak Hendang.
Oh, that's why I'm wondering. Yeah. Yes. So can you see my slide already?
Yes, if we, I can see. I think we can all see your slide.
Okay, that's good. That's good. Because we're waiting. Do you want me to start or wait for Pak Hendang?
Please start, Bu Ningsi.
Okay, I can start. Yeah. Okay. Thank you. Let me. So very good evening for everyone, to Pak Hendang, moderator, to panelists and webinar participants.
Okay.
Okay, can you hear my voice?
Yes, thank you.
Okay. So I'm very delighted with the opportunity to participate in the Accounting Expo 2020. In the next 20 minutes, I will briefly share the enhanced audit report and key audit matters, which are the significant breakthrough in auditors' report. So let me move to the next slide. So actually, when I was asked by the learning divisions of IAPI to deliver webinar on the topic CAM in the Accounting Expo, the executive director of IAPI, Pak Denny, asked me to somehow link the integrated reporting to CAM in my presentations. So my first reaction is, I don't think we can directly connect integrated reporting to CAM, because these are two different subjects. CAM is driven by auditing standards, SA 701, and it applies to the audit of historical financial statements, while integrated reporting, based on my very little knowledge, but I have more knowledge today after hearing the presentation from Jonathan, Stathis, and Paul, is a corporate reporting model which is beyond a sole focus on historical records of financial performance. I happen to see few examples of integrated reports where the audited financial statements.
Ibu Ningsi,
yeah.
Please start your video.
Oh, okay. Okay, can you see me right now?
Yes, thank you.
Yeah, so I happen to see few examples, of integrated reports where the audited financial statement are in the table of contents. of those integrated reports. That's why if you see in this chart, yeah, I try to actually connect, yeah, we have integrated reporting, and inside of integrated reporting, there's a historical financial statements and also other informations, yeah, like what Paul, Statis, and Jonathan, yeah, already shared with you. So today, actually, our focus, yeah, my focus on presentation is more on the key audit matters, yeah. So although actually in my view, yeah, integrated reporting and CAM are not directly connected to each other, but I saw a similar spirit, yeah, behind it, which is to inspire greater transparency and provide value and greater insights to the users of audit report and integrated reporting. So as you know that after the financial crisis in 2008-2009, and in response to strong calls by investors and other users of financial statement for more relevant and useful information from the audit, the International Auditing and Assurance Standards Board issued a new and revised enhanced auditor reports in 2015. These standards have been adopted by many countries since then, including many countries in the region. The Indonesian Auditing and Assurance Standard Boards already issued exposure draft of SA 700 series in December 2019, and the standard is planned to be effective in 2022. So the most significant change in enhanced audit report, yeah, I will call it EAR from now on, is the disclosure of CAM, yeah, key audit matters, as a new separate paragraph in the auditor's report for listed entity. Yeah. So what changed? Yeah. Let's see, yeah, the change in nutshell. Yeah, the first one, a report reorder. As you can see, auditor report now become the first one. Yeah, opinion required to go first. And in addition to that, auditor of listed entity will need to report key audit matters. And auditors will need to explicitly, yeah, mentions material uncertainty about the entity's ability to continue as a going concern in a separate paragraph when this condition exists. And the other one, yeah, number 7, if you can see in here, is auditor will need to make an explicit statement on other informations that accompany financial statement in the annual report in terms of any inconsistency they may or may not have identified. So let's now see, yeah, what are the key audit matters. I think for you who already joined the webinar on this topic in June, you are familiar, yeah, with this definition. But I think for the one who have not joined that, let me explain what are the key audit matters. As mentioned earlier, the most significant change in enhanced audit report is the inclusion of CAM in the auditor reports for listed entity. Yeah. So CAM are basically those matters that in the auditor's judgment, professional judgment, were of the most significant in the audit of the entity financial statement of the current period. Yeah, so it's only for the current period. And CAM are selected from matters communicated with those charged with governance. So CAM will enhance the communicative value of the auditor's report by providing transparency about the audit. CAM will provide additional information to users, understand the professional judgment of the auditors, and the area of significant management judgment in the audited financial statement. Last but not least, by using information in CAM, users will be encouraged to further engage with the audit committee and management in order to better understand the company performance and guide the investment decision making. So investor may be inspired, yeah, to ask more relevant questions relating to CAM audit matter during the AGM. And if you talk about what CAMs can do, this is what CAM are not. Yeah, so CAMs are not suitable of the prepare a review report in the financial statement. So basically, CAM is not a substitute of disclosure in the financial statement. And CAM also is not a substitute for expressing a modified opinion and reporting material uncertainty related to a going concern. Also, CAM is not an implication that a matter has not been resolved by auditor. So communicating CAMs in the auditor report does not imply that we issue a separate opinion on each CAM, as there's only one opinion that covers the financial statement as a whole. So this is the value of communicating CAM. Yeah, communicating CAM will bring value beyond providing better informations or better transparency to the intended users. There are more value of communicating CAM, such as contribute better governance through better communications between auditor and those charged with governance, contribute to higher audit quality, contribute to higher quality of financial reporting, and last but not least, actually, CAM will renew the interest in the audited report, just beyond unqualified and qualified opinions. I think you can resonate, that for many users of audit report, maybe including all of us, for many years, users may not pay attention in every single word that are written in the auditor reports. But in the near future, after we adopt the enhanced audit report and CAM, users may have to spend at least an hour or maybe hours to read the whole report in full in order to get a more informative information. So let's now go step by step on how we determine CAM. So basically, to determine CAM is a funnel approach. Starting from the matters that were communicated with those charged with governance, and then we filter into matters that require significant auditor attentions in the performing the audit, and then we filter in to matter of most significance to the audit, and this one become CAM. So let's start with the step one. So step one, CAM should be identified from the matters communicated with those charged with governance. I think we can resonate with our audit committee. Actually, matters communicated with audit committee are not new procedures for auditors, and auditors have been required to have communications with those charged with governance in accordance with SA 260. So those communicated matters could include auditor responsibility in relation to the financial statement audit, timing of audit process, significant risk, audit approach to respond to the significant risk, and significant findings from the audit, including findings related to control deficiency. And then after we done with the step one, we go to the step two. So from the matters communicated to those charged with governance, auditor will identify the matters that require significant auditor attention. These primarily relate to matters that pose challenge to the auditor in forming an opinion or obtaining evidence that in his or her judgment was sufficient and appropriate under circumstances. In this step two, to determine matters that require significant auditor attention, auditors are required to take into account, of course, first area of higher assessed risk of misstatement or significant risk, and the area with significant auditor judgment relating to the area in the financial statements that involve significant management judgment, including accounting estimate as having high estimation uncertainty, and the effect on the audit of significant events or transactions that occur during the period. So we finish with step two, and now we come to the step three. In step three, auditors need to determine which of the matters identified in step two were the most significant in the audit of the financial statements of the current period. So determining which and how many matters of most significant is a matter of professional judgment. The number of CAM to be included in audit report may be affected by the size and complexity of the entity, nature of its business and environment, and also fact and circumstances that we noted during the audit. Actually, there's no threshold for the number of CAM to be communicated by the auditor. different entities in the same industry can have different camps. Yeah, and it's possible, yeah, for camps to be different in different year, but of course cannot be entirely different, yeah, unless there are significant changes or new transaction enter into that year by an entity. So we finished, yeah, on how to determine camp, step 1, step 2, step 3, and hope all of you can remember, yeah, from step 1 to step 3. Yeah, it's not difficult, but I think when it comes to the practical adoption, it's going to be quite challenging. Yeah. So what typically constitute camp? Yeah. So as you can see, matters that relate to significant or complex matters, yeah, disclosed in the financial statement, for example, assessment of impairment, valuation of goodwill, valuation of financial instrument, difficult or unique revenue recognitions, or if the company just have a business combination, acquisition, then accounting for business combinations. Also matters that involve significant complexity of subjectivity in the management selection of accounting policy. And also matters that involve significant management assumptions and estimation uncertainties, and also significant weaknesses in internal control that have a material impact on the financial statements. So now probably you may questioning, yeah, whether material uncertainty on the entity's ability to continue as a going concern is a camp or not. The answer is yes. Yeah, ISA 701 specifically highlights that a material uncertainty related to going concern is by its nature camp. So if this condition exists, then it should be described in a separate paragraph for going concern in the auditor's report. Yeah, remember, now there is a separate paragraph for going concern under the enhanced auditor reporting. Yeah, but the auditor should not disclose this. Yeah, although going concern is a camp by nature, the auditor should not disclose this in both going concern and camp section. But in the camp section, they should just make a reference, yeah, to the material uncertainty that has been described in the going concern section. Yeah. So now let's move to the next one. This is another question. Yeah. So if matters giving rise to a qualified or adverse opinion, are they camp or not? The answer yes, they are camp by nature. Yeah. So when we express a qualified or adverse opinion, we shall add a statement. Yeah, we shall add a statement in auditor's report. Yeah, it really depends on the condition. Yeah, the first condition. Yeah, if there are other camps in addition to matters already described in the basis of qualified or adverse opinion paragraph, yeah, then actually basically we already explained in there. Yeah, but there are also other conditions, yeah, in which a situation where there are no other camps to communicate. So in that kind of situations, yeah, if there are no other camps to communicate, yeah, then actually we can just put that additional informations, yeah, in this kind of wording. Yeah, so this is actually an example of language, yeah, example of language which we can use, yeah, we can use, okay, in a situation when matters giving rise to a qualified or adverse opinion. Yeah, so let's see now exceptions for reporting camp. Yeah, there are certain exceptions when actually auditor do not need to report camp. Yeah, the first one, when the law or regulation precludes, yeah, public disclosure about the matter, or the auditor determines, yeah, that the adverse consequence of communicating the matters in the auditor's report may outweigh the public interest benefit of such communication. Yeah, in both conditions, written representation from management are required, yeah, under the standard. Yeah, and the standard also mentioned, if the auditor disclaim of opinion, then there will be no disclosure of camp. Yeah. Apart from what I have just mentioned, there could be very limited, yeah, situation where there are no camps to be communicated. Yeah, example of this very rare situation is a listed entity that has very limited operations. Yeah, so maybe they don't have camp, yeah, in that kind of condition. the auditing standards do not suggest an optimal number of CAM. So the number of CAM are not regulated by the standard, or they suggest the optimal number of CAMs, but stated that it's rare to not have at least one CAM. I think that makes sense, because actually CAM is applicable for listed entity. In my view, for listed entity, unless if they have a very limited operation, at least, there will be one CAM. So now let's see, the key audit matter section in audit report. This is actually what need to be in the CAM section. The first one is basically just the explanation of what CAM is, and confirmation that we form an opinion, on the financial statement as a whole. So we don't form an opinion on each CAM. Then it's important to explain, about the key audit matters. So the name of key audit matters, and then there will be a reference to the financial statements, and describe the matter. And the other important thing is to explain why it was considered to be one of the most significant in the audit. Then the auditor should explain, should describe how the matters was addressed in our audit. So basically, like an audit procedures. So while the standards do not require auditors to include the outcome or result of the CAM procedures, auditor might include conclusions or finding voluntarily, although it's not required by the standard. The aim of including conclusions is to help readers understand how auditor address its CAM in the audit. However, auditors should be mindful that the inclusions of conclusion in its CAM will not be construed by readers as if auditors suggesting a standalone opinion on the element or accounts of financial statements. I would like the next one. I'm going to go through this very quick. So about the quality of communication, because this is very important. The quality of communication in the CAM is important. To the missions of enhancing the value and relevance to the audited report. So with that, CAMs are expected to be the entity specific or tailored. It's not a general or boilerplate statement, because CAM is intended to offer relevant and useful insights. Boilerplate reporting of CAM will, with unclear language, will defeat the CAM objective, will defeat the CAM purpose, and then it will return auditor reports to the binary informations.
Excuse me, Ibu Ningsi, 5 minutes more. Can you make it because of the run of time?
Yes, okay. I will go really quick. So actually, I have 3 examples of CAM. Because of the interest of time, I'll just go through really quick. The example 1. As you can see, in this example, there is the title of the CAM, the translation of foreign currency denominated transaction and balance. There's a description of CAM, and there's a reason why this is CAM. And then the next one, there's an explanation how our audit addressed the CAM. Basically a list of our audit procedures. And in this example, there's a conclusions. The conclusions that the auditors make a sharing, actually is a sharing, a conclusions resulting from the performance of audit procedures. So I'm going to skip example 2. Later on, I believe that the organizer will share the slide, and then you can see example 2 and also example 3. Actually, I got it from the public informations, and I would like actually to share this part, which I think this is the most important thing. This CAM is actually impact the whole financial reporting ecosystem. Key audit matter is driven by auditing standard. I personally found that this is a very rare auditing standard, because to successfully implement this standard, all parties within the financial reporting ecosystem, actually they have an important role to play in enhancing the quality of financial statements audit, and in the longer term, improve confidence in the capital market. So I personally believe that this is a game changer in the history of audit report. So let's now see who are affected by this change other than obviously auditor. The first one is audit committee. If you see in the slide, is actually there are several suggestions for audit committee once we adopt CAM. However, I would like to take this opportunity to suggest some action. It's not in the slide. Some actions that audit committee can do between now until the standard is effective 2022. First, start educating the boards and investors about the enhanced audit report and key audit matters. Start initiating discussion with your auditors on the implementation plan and also agree the timeline. And also consider conducting dry run. For what I read in several publications on the first year implementation of CAM, it is highly recommended to do a dry run. If you are the investor, then what you have to pay attention. First, understanding what information will be in the enhanced audit report, familiarizing yourself with enhanced audit report, maybe by reviewing reports that were issued. Many reports have been issued in the countries that already implement CAM, Singapore, Australia, UK, etc. And then identifying how the information may be used for investor to evaluate and compare companies, and determining how the information may be used to engage, to make an engagement with audit committee and management. If you are the member of the management team, then management needs to be aware that there will be more detailed descriptions of management responsibility in enhanced audit report. It is a good time for management to revisit your financial statements disclosure to ensure that they are clear and concise, because CAM oftentimes direct users to the note disclosure, and support and corporate dry run and agree timetable with your auditor for the first year implementation. Regulator will be able to see greater transparency and independence about the audit that was performed. So I have 2 more slides. I will run very quick. About the applicability. It is mandatory for listed entities. For audits of general, for the complete set of general purpose financial statement of listed entity. For listed entity, mandatory. How about the rest? It depends. When auditors are required by law or regulations to disclose CAM, then that will become requirement, or when the auditors otherwise decide to. I'm come to the next slides. This is the roadmap of adopting CAM in Indonesia. So given the big shift in the new reporting standard, today is actually the third awareness sessions that IAPI, together with other associations, facilitated the webinar on the topic of CAM. The first webinar in June, and yesterday actually another webinar with the Institute Audit Committee, which Pak Hadri Sendra was one of the panelists. And on behalf of the Indonesian Auditing and Assurance Standard Board, we are very supportive to the adoption of this standard. We are planning for socialization of new SA 700 series in the near futures. And I think the most important thing and also interesting part is this standard will become effective. So SA 700 series, including SA 701 CAM, will become effective for the financial statement, beginning on or after January 1st, 2022. Especially for CAM, we will start with listed entity. So basically, we only have 15 months to prepare and get ready for this change. Given the magnitude of the change, and also its imminent commencement date, 1st January 2020, all stakeholders should rapidly prepare themselves for the new change. Dry runs are strongly encouraged so that audit committee, management, and auditors might experience the process, particularly on the communication part, and understand what might be in the CAM and how they would be described and written. I think that's very, very important. In this way, there will be minimal surprise or delays when the first audit report with CAM is due to be published. If this is effective January 2020, then the first financial statement to be published with CAM will be in 2023. Yeah, so time is running. Yeah, basically preparations at get ready is very important. So thank you for your attention. Stay tuned for the next webinar. So
Thank
Pak
you.
Hendang,
Thank you, Ibu Ningsi.
transfer the platform to you.
Okay, thank you, Ibu Ningsi. That's all of our presentation, which is the three of the panelists talking about the integrated reporting, and the last panelist, Mr. Ibu Ningsi, talking about key audit matters. Yeah, I think that because of the run of time, I will not need to wrap up the material. I think that you will also already understand about this, because we still have to learn about the question and answer. Before we discuss the materials, let me share with you about the keywords from for fill out the form in order to get the e-certificate webinars. The keyword is Institut Akuntan Publik Indonesia. So please use it for fill out the form. Yeah, thank you. Now I have about several questions, but I think that because of the run of time, maybe we cannot all. This is about 10 questions, but maybe we will select until just only for 5 questions. The first question is about from Aditya Prabowo, from Kap Junaidi, Charul, and Rekan. The question is, many companies in developing countries, for example, Indonesia, do not yet understand the importance of integrated reporting. How can we convince the company about the importance of the integrated reporting process and the importance of the role of accountant in the company if we are an external auditors? I think that maybe first question could be answered by Mr. Paul. Mr. Paul, together with Jonathan, please, about how the role of external auditors could contribute in building the awareness of and needed of integrated reporting in Indonesia.
Okay, Jonathan, you want to go ahead, or shall I go ahead first?
I'm happy to go ahead. Yeah, absolutely.
Okay, go ahead.
Yeah, and then yeah, I'll hand over to you, Paul. So, well, the first thing to say is that there is now, thank you for the question, that there is an established business case now for integrated reporting, and I'd be happy to share that with you. It's only a 2-page document that we've put together, which combines all the evidence and practice from around the world to show the value now of companies that are adopting integrated reporting. And in brief, the benefits are that businesses that are adopting integrated reporting attract a longer-term investor and deter short-term investors and traders. Secondly, integrated reporting leads to higher share price performance, and this is a study that was done by Nanyang University in Singapore, looking at the South African example, because in South Africa, integrated reporting is the normal practice for corporate reporting. And the third example is that integrated reporting leads to companies benefiting from a lower cost of capital. And that is a study that's been conducted by KPMG in Singapore, looking at the ASEAN region and comparing 80 companies in the ASEAN region, sorry, the APEC economic region, I apologize, 80 companies that were practicing integrated reporting and 80 companies that were not. And they found that in every single case, the companies adopting integrated reporting benefited from a lower cost of capital. Now, auditors are becoming really pivotal here in 2 ways. One, because they're providing advice to the companies and to the CFOs and saying, actually, you've now got to measure these broader values, these broader drivers of value creation. But also the auditing firms are now providing assurance over the information in an integrated report. So there are examples of companies like, for example, CBOS, the pension fund in Australia. They now have assurance over their integrated report, and what that's doing is providing more trust in this broader range of information that the company is providing to the shareholders. So on the one hand, there is now an established business case, and the auditors are becoming more involved because they're providing advice to the finance teams within the organizations, but they're also providing these assurance services that is helping to build trust in the information in an integrated report.
Okay, thank you. Mr. Paul, have you any comment on that?
Yeah, I think from the corporate board director's perspective, we often take the audit assurance report. It's more or less like like the gospel truth, you know. We present it to our shareholders. In fact, we present our board first, and board accepted, we present our shareholders. That is where the financial position of the company is. So as I've tried to demonstrate just now, that the value of the company from a market perception is grossly different from the book value that we have. And when we just present the financial performance of the company based on the financials, which is transaction financial, we actually, I feel that we actually grossly underrepresent or otherwise not fully discharging our fiduciary responsibility to our shareholders, okay? Now, I have served in the one company before where the company's asset, or where the company the company has not revalued or reassessed the asset value of the company for the last 15 years. I served in a company and I brought back to the board for the last 3 years, and they were resisting the revaluation. The reason why was that because one of the major shareholders want to press the price down so they can buy more shares, all right? Now, how is it related to this intangible value is this? If I see that the company has invested a lot, or rather spent a lot of money and human capital development in R&D and so on and so forth, and the more that they spend on it, the worse the performance that we see in the financials, they are right for corporate raiders, you know, right? So what I'm trying to relate to is that when they do the financial reporting, we know the essentialness, the vital or the criticalness of this financial assurance that we get from auditors. But at the same time, you must also be conscious that what has been invested in very essential capital, we call it human capital or intellectual capital. If we take the leadership at all in our industry, we need to invest in that. But that does not reflect in the financials, right? So I'm not suggesting that we disrupt the international financial reporting as a standard. I'm not suggesting that, you know, that can continue with it, but we need to also report how are we invested in other intangible assets, right? So I think that's very, very important from board perspective. Okay.
Okay, thank you, Mr. Paul. And the next question is from Viantoni. He asked about the more important of intangible asset value creation, the more company value. How to determine the intangible asset? Because it is in this integrated reporting. Beyond that, just record in the balance sheet value. I mean that how to value the intangible value of intangible asset, because of some of the intangible is not reflected in the balance sheet value. Maybe Mr. Statis could help us. Thank you.
Thank you, Hendang. That's a very good question. It's a very challenging area and a very important one. Of course, they're absolutely right. The way the financial statements capture intangible value, particularly around goodwill, is based on a transactional value and or subject to a transaction. So as Paul quite rightly said in his presentation, many important aspects of intangibles and the value arising from intangibles within the current requirements of financial reporting standards can never fully be captured. So the question therefore has to be, how do you capture those? And I think one of the important things here is there's an element of using measurement and key performance indicators to measure whether it's important things around your employees or your customers or your supply chain. But intangibles generally don't have any value without a strategic context. And so the link between measurement and KPIs and the strategic context is really fulfilled through the qualitative and narrative explanation and illumination that one has to give around how those intangibles are being managed and nurtured within the organization, and helping the organization actually deliver a unique value proposition and competitive advantage. So ultimately, it's that uniqueness and how companies are leveraging and nurturing their intangible assets, whether it's customers, people, suppliers, innovation, R&D, etc. That sort of explanation, I think, is really, really important and a very critical part of integrated reporting, because the numbers can never tell you the whole story, or the KPIs can never tell you the whole story.
Okay, thank you. There is another question for, I think that I will ask Ibu Ningsi about the key audit matters. If management or those charged with governance do not want to disclose the key audit matters in the audit report, what should auditors do? Please help me, Ibu Kusuma Ningsi.
Yes, okay. I think that's a very interesting questions, and it's expected, because it's very common, that this is quite a tricky part, and there's going to be a very lengthy discussions, between audit committee, management, and auditors, to what need to be included in the CAM. So what need to be in the CAM is auditor professional judgment, because auditor will select, from matters already communicated with the audit committee and select the most significant one. So if the auditor believe, that's the most significant one, and that needs to be included in the CAM, and then the management, or the management or audit committee refuse, to do it, I believe that's going to impact to our audit opinion. Because basically it's like something that needs to be included, but they don't want to be included, in there. So that's why it's very important, for this one, when we adopt CAM, first, the planning, the discussion should be as early as possible, because sometimes maybe at the end, it's just the disagreement about the wording, it's not about the matters that need to be included, but could be the wordings, or could be about the reason why, it could be about many things, So it's better, to start as early as possible, Actually, CAM is about the communication, about the engagement between auditors and audit committee and management, So start the communication as early as possible, and already identify the possible CAM, from the planning and also from the interim, not wait until the last minute, although it's going to be included in audit report, but they don't need to wait until the last minute. And for us, for the first year implementation, and actually I had a chance to read many thought leadership, for the first year implementation of CAM. For all the thought leadership that I read, most of the, including actually also the webinar, that I heard, dry run is very important. So if we are going to make it effective, the standard in January, starting for financial statement January 2022, then actually next year, for the listed company is highly recommended already start the dry run. Because the dry run next year and then effective in 2022.
Okay. If I may add that, because of the multiplier effect of the sufficient and appropriate audit evidence that make us for the disclaimer opinion, I think that CAM is not needed for the
yes. If we disclaim opinion, then CAM actually standard say we cannot disclose CAM. If that's a disclaimer. You are correct, Pak Hendang.
Thank you. And the last question for our discussion is, I will ask Mr. Jonathan or Mr. Paul again about the CAM. If come if key audit matters will be implemented in auditor's report later, how it become a value creator in integrated reporting? I think that this is the combined question about the CAM and integrated reporting. So please help me to answer that. Jonathan or Paul, please. You got the point? About the relationship of the key audit matters and the integrated reporting.
Yes, I do. Paul, I don't know if you wanted to go first.
Go ahead. That's okay.
Yeah.
Please go ahead.
Well, the key audit matters, and the specifics to me are they're new. So what I've been doing is taking quite a lot of notes, and I need to go away and consider that and come back to you. So I don't have an immediate response. So I was hoping that Paul, I don't know if you have an immediate reflection on it, but I need to go away and think about it and come back to you.
I have a thought as well, Paul. I think, I think they're not directly connected, but I think it's important to think about the role of the auditor and audit committee and the board in understanding non-financial risks, because non-financial risks and what's happening around the organization in the company are ultimately, as Jonathan quite rightly stated, will have a financial consequence. And so as accountants and auditors, as we evolve, we are going to be dealing much more increasingly with critical non-financial risks, which will have an impact on financial performance and on the accounting. So I think over time, there's likely to be much more thought around, how auditors in an assurance engagement can highlight those critical non-financial risks and what is being done to manage and account for those. So I think the horizon and the perspective of auditors related to critical audit matters will evolve over time, and it wouldn't surprise me if much more of what we do as auditors relates to non-financial matters, and that's only a matter of time, because it's ultimately financial performance is an outcome or as a result of other things that are going on in the organization that we're doing to manage the organization. So it's I think a close relationship, although in terms of CAMs right now there isn't a direct relationship.
Okay, so Paul, please. Paul?
Yeah, okay. I was also have submitted ASB before on the Malaysian side. I think the core reason that we bring out all this key CAM is to determine the ongoing concern of a company, all right? And anything that impact the ongoing concern of the company, that ought to be highlighted in the CAM, right? But again, the very critical area they look at is usually the cash flow and also the prospect of the business. All right, but we do not really look into other areas like the intangibles, what are invested in, for example, the human capital, invested in research and development, because all these are all written off. Now, where I'm coming from is this: I've been always emphasizing that yes, we would not disrupt the IFRS standard, but if we are invested in those kind of areas, we ought to highlight what we invested into it. For example, like generally we say that it is costs of staff costs and things like that, or we write it off. If that is highlighted, we would know, all right, where, so to say, when we follow the money, we know where we are emphasized when we are allocated our capital into, all right? Now, as I said, I mean, it is not really a quantifiable value, but it's quantifiable in the sense of where we have devoted our resources into, for what purpose, all right? Let's say for human capital development, what area of human capital development are we talking about? If a company is in technology company or in any other industry at all, that requires the human capital to reinvent themselves or to reskill themselves. Now, those are very important elements. As an investor, I will look at it this way: if a company that invests a lot of human capital and R&D, I tend to incline that we are on the leading edge in the business. All right. So, where does it relate to in terms of value creation? It is subjective, though, but by disclosing it, you will find that those savvy investors will be able to extract the value out of where the money is invested in, or where the capital is allocated to, right? But no, you don't have to disrupt the IFRS. Leave it as it is, right? Okay, that's my thought.
Okay, I think that from my side is that both of integrated reporting and key audit matters have the same goal, is that how to make us more transparency. I mean that for the reporting entity, I mean the transparency itself will be valued by the investor. Maybe by getting the cost of fund, the cost of capital is more cheaper, or by another benefit, yeah, because that overdue that will be outweighed the cost of providing the information, whether it is integrated reporting or the key audit firm, the key audit matter. The key audit matter is an effort by the auditors, and the integrated reporting is an effort by the reporting entity in order to make it more transparency reporting. Thank you very much. That's all of the session. I think that I wish to thank you to all of the panelists, the distinguished panelists, and also all of the participants, and also all of the organizing supporting, such as IFAC, also EAPI, and all from the Ministry of Finance, profession of supremacy center. I think that this is the last session. If you have already filled out the survey form and select the keyword, I think that you will get the e-certificate. So now I will hand over to the MC, Ari. Please take the time. Thank you.
Thank you, Mr. Hendang. I would like also to say thank you to all speakers today, Mr. Paul, Mr. Statisdol, Mr. Jonathan Lebri, and also Ibu Kusumaningsi Angkawijaya. Thank you. This is a very good opportunity for us to learn about integrated reporting and key audit matters right from the expert itself. I hope we can meet again in another webinars. Bapak Ibu, rekan-rekan semuanya, jangan lupa untuk memasukkan kata kunci yang tadi sudah ditayangkan dan disebutkan oleh moderator. Kata kunci dapat diisi melalui link survei sebagaimana sudah ditampilkan di layar Bapak Ibu. Dan juga kami tampilkan link untuk mendownload materi dan sertifikat. Namun sertifikat baru dapat didownload setelah tanggal 31 Oktober 2020. Demikianlah webinar pada hari ini. Jangan lupa untuk tetap ikuti rangkaian kegiatan Expo Profesi Keuangan 2020 sampai dengan tanggal 16 Oktober 2020. Rangkaian webinar besok akan dilanjutkan dengan sesi webinar yang keempat berjudul Push and Pull Factors dalam Transformasi Digital. Jangan lupa untuk menyaksikan webinar yang keempat. Ikuti terus update-nya juga melalui Instagram @profesikeuanganexpo. Saya Ari Yuliarti dan segenap tim yang bertugas pada hari ini pamit undur diri. Selamat sore dan selamat beraktivitas. Wassalamualaikum warahmatullahi wabarakatuh.
Keep healthy. Thank you.
Thank you, everyone.
Ya, thank you.